Hello, I'm Keith Boyle. I'm the CEO at Newfound Gold Corporation, and I'm very excited today to present to you our preliminary economic assessment, the first one for the Queensway Gold Project.
Keith, good to have you on board. Thank you very much for joining us. Now, hot off the heels of the initial resource estimate, PEA, you're moving through the phases quite quickly. So tell us a little bit more about this. Give me the numbers.
All right. Well, high level, we're producing 1.5 million ounces of gold over a 15-year mine life. When you step back, how did we get there? We've looked at it in a phased approach. Because we have this high-grade core that starts at surface, we decided to phase it in such a way that we would start small and minimize the capex, and then grow the operation using the cash flow from that smaller one. That way it'll minimize the amount of capital we have to raise for the build, and will generate better returns for our shareholders.
But it's always been the case in Canadian mining. Big is beautiful. So let's explain this model of trying to generate early cash to finance the growth.
Yeah. So phased approach. Phase one is to build a small mine, 700 tons per day. The capex on that is estimated at $155 million. That'll run for 5 years. In parallel, in years 3 and 4, then we're going to build a 7,000 ton a day plant on site. So the first phase is using a toll mill in Newfoundland. So start a small mine using a toll mill off site, and then build a plant of our own at 7,000 tons a day during years 3 and 4 while the cash flow is coming from the small mine. And so that second phase will then get us started in year 5, and the first 5 years of operation, so years 5 to 9, will generate 172,000 ounces a year at just over $1,000 all-in sustaining.
Right, and talk to me about the NPV. I want to understand the numbers and how the market will perceive these things. Obviously, at 2,500 gold, which I think is the assumption that you're using, it's 742 million, 56% IRR. It sounds attractive, but given this kind of starter approach, this staged approach, what comfort have you got that you're going to be able to hit the numbers that you're talking about, and what's it going to do for you if you don't?
So I guess the best way to put it is that we looked at this scoping level study, and in working with the engineers, what the best way to put it, I would say, is conservatively, simply because it is a scoping level study. And we sacrificed NPV for IRR. In other words, in phasing the approach, we really pushed out that big production number because the capital cost of the small starter is much more attractive to us and much better fit for our shareholders.
Yeah, and I guess, of course, at 3,300 or whatever it is today, the numbers do improve. You talk about getting up to nearly 1.5 billion. Those are the sorts of numbers that are attractive to institutional investors. You've been on a roadshow. You raised a ton of money recently. What are they expecting to see from you? And and how do you kind of pitch this to them? This less efficient starter package?
Well, as I said, our objective was to get to cash flow as soon as we could. So with the money we've raised, we're putting everything in place with that objective. And the objective to get to cash flow as soon as we can, we're looking at basically permitting next year, so submitting our application at the beginning of the year and having our permits by the end of the year, so that we're in construction in early 27. That's our objective, And so we would, we may be in a position towards, I would say, end of third quarter of next year to even start some early works. And that, to me, that's the most efficient use of the money we've raised so far, is let's get to cash flow and use the cash flow to build a fantastic operation that, we have, as part of this MRE, we converted a very high percentage of the resource. And so by doing that, and it really shows the robustness of the resource that we do have. And then so on the second point is that to look at the larger operation right away, probably shovel in the ground wouldn't be doable until almost 2029 with all the work that would have to go into it. So by starting small, we can start cash flow right away, and we're not talking, we're talking significant cash flow, because, that initial phase of only 155 million, generating just 69,000 ounces a year, but with a, $2,000 US an ounce margin on those ounces. That's significant cash flow.
It is. So there's, I guess you've made a bunch of assumptions around this, and I'd like to kind of dig into those if I can, in terms of, critical path permitting items, or assumptions around kind of cutoff, and assumptions around tailings management. So can you talk through all those trade-offs that you have to kind of go through to kind of get to this PEA?
Yeah. So the next steps really are, for us, is to look at, okay, what does that small mine look like from start to finish? Secondly, we are looking at, when we do build a process plant on site, so starting in year 5, our tailings deposition will be using empty pits, so we won't have to build a tailings dam. That's best in class tailings facility. There's, the long-term liability of any tailings dam just goes away as a result. The third part of the trade-offs for us is really part of our drilling program this year is to do definition drilling where we will start mining. So in other words, that bulk sample area that we had contemplated, in speaking with the government, they actually pointed us in the direction of, saying it would take as long to permit a small mine as it would to permit a bulk sample, given the regime they've got. And what we're really encouraged by is how supportive the government have been. They've stated they want 5 mines by 2030. And, we've got some real live examples. Maritime Resources got their permits all done in 10.5 months. Most recently, Firefly got their environmental assessment in 45 days, which, that's, unheard of. However, the consulting group that was used was the same consulting group we happen to be using, and Stantec will take the learnings that they've had from that and make sure that our applications are fulsome for the government to help us get those permits in time. So now we've allowed a year as part of our timetable, so submitting our application at the beginning of the year, and going through 26, the permitting, all the while doing the necessary detailed engineering, and possibly starting some early works to be in a position to then order some long lead items in order to be in a position to start our construction in 2027. So we think we've got a reasonable approach Still lots of work to do yet to get there, but a reasonable approach to meet a very quick timeline that to get to production.
Right, which seems to be the name of the game at the market at the moment. But I know this is not about NPV and this is about cash generation, but you use an NPV5 number. It suggests that whilst going through this PEA study phase, you're quite quietly confident about your ability to deliver. You weren't applying NPV 8 or 10 on this one. What were the things that you learned about the project as you were working through the PEA, which kind of delighted you to the upside?
Firstly, geologically, the grade. Typically in these kinds of grades or in these kinds of high-grade veins, my experience has always been with this kind of approach and the estimating of the ounces. In other words, top cuts and limiting the influence of high grades, especially in the maiden resource. I've always had overcalls, in other words, more ounces than what was originally estimated when we hit those high grades. And so for us, that's why it's important to do that definition drilling of those high grade veins right at surface in the coming this year, in order to then include that as part of an update to the mineral resource. Secondly, I'll say we hired an engineering firm that's known for its conservatism, and so in my terms, we didn't stretch the elastic in any sense when it came to estimating production rates, recoveries, and capital and operating costs. So, from what I've seen, there's room in all those buckets that will allow us through the detailed engineering to better optimize the start. And then the third part is that this small start, I'll call it an engineering approach, where we've laid it out in a way that a very logical and prudent approach. Oftentimes, these small mines, you'll hear the term bootstrap. So how can we get it started without necessarily, spending all this money up front? And having been in that world where I've had to survive during the financial crisis of 2008, as an example, people get quite inventive, and for us, I think this first phase we've got some room to optimize on. I'll give you a couple of examples. One is we have allowed, I think it's $40 million for an upgrade of this tool mill that we're looking at, but really, probably much smaller number to get it started, so it may not start at the full rate, but then we can build the full rate over the few months, or contract mining to get started. We have a full fleet in this capital that we've got outlined, so perhaps we start with contract mining and don't have to raise quite as much. So these kind of optimizations give me the comfort that we've got room to maneuver and see how we can do better than what we've got in the PEA.
Okay, so contingencies in place and no over-engineering of this for sure. But let me ask the flip side of that question that I asked earlier, which is, what are the things that you've got your eye on? You say to the team, look, we need to stay on top of that. Those are potential problems down the line if we're not careful. You've done this before multiple times, so can you give us a sense of what instructions you've given to the team to make sure things don't fall over?
I've more or less laid it out, but the first instruction was we're going to drill off the high-grade veins at 5-meter centers so that we have all the data required to do a proper evaluation of the high-grade veins and know what the statistics should be so that we can further extended through the entire deposit. Second is the permitting. We want to make sure we've covered all bases, especially in the baseline data work, so that we'll have everything we need when we submit our application, that there aren't any holes in it. And so Jared, our Vice President of Sustainability, and Stantec have been working hand in hand to make sure that we have all the information, especially with what Stantec has learned on the permitting of Firefly and being so successful with that. So that's the second one, and then with Rob on the mine and the design, it's we've got an overall plan now. How do we make it better? By one, bootstrapping the start, and two, really understanding what we want as phase two.
Right. I want to come back to the kind of phased approach. Okay, years 1 through 4, and then years 5 through 9, etc. You talk about in the kind of first phase, you're not going to really start the build out until years 3 and 4. Is that just explain why? Obviously, you're building up cash reserves, but is it also partly say, well, let's see if we can mine this the way that we think we can mine this? Is it what's happening during years 1 through 4?
No, so during years 1 through 4, so basically the small mine is about a 6-month build, and so in the first year we'll be producing for the second half of that year. However, we'll then have to apply for our permits in that first year for the expansion, and we've basically allowed for 18 months to 2 years to permit the larger operation. At 7,000 tons a day, it does tick into the federal regime, and so that's why we've allowed a 2-year time frame for the permitting of phase 2. Having said that, there have been horror stories of the feds taking much longer than that. However, we're quite encouraged here in Newfoundland, other provinces, and at the federal level, all stating and showing that they're trying to cut the permitting timelines for major projects and major mines. And so we think that a 2-year assumption to permit that larger operation is reasonable in this case. However, we're not beholden to it, because we'll have a small mine that will be able to go for longer than that. We just felt that it was an appropriate assumption in this case.
Right. Okay. Now, obviously, there's a significant leap from years 5 through 9. It leaks by another 103 million ounces, up to 172,000 ounces a year. It puts you in good company for sure, but a fair bit of OPEX required for that kind of increase from 700 through to 7,000 tons per day. How does the team manage that? How are you going to have to evolve to be able to kind of just step change like that? And when does that start?
During the years 1 and 2, as I've said, we're going to apply for the permit and do the feasibility study that will be required, and then the detailed engineering that will follow. So, targeting a feasibility study end of next year, beginning of 27, with the view of getting the appropriate detailed engineering done while the permitting process is ongoing, and then be in a position to order the long lead items for construction in year 3. And I think it's a fairly smooth transition once you're up and running with the small one. That in parallel, there's a group that stays focused on the construction while the operating people look after the operation. Post that, we've got our third phase, which is the underground. And once the large plant is running in year 5, then we'll look to develop the underground. And during the 4 years, that'll allow us to do the appropriate definition drilling for the underground and appropriate engineering to define what it is we're going to mine.
Right, and obviously you've obviously been through the figures here. It's a PEA. People go plus or minus 30% typically on these things. How conservative have you been, and what assumptions have you made when it comes to things like the fuel, labor, consumables, mining, processing, power, etc.? Have you got a kind of good grip on that?
Short answer is yes. We've got, from a fuel perspective, we've got today's price, which makes sense. We've got a gold price of $2,500. As far as operating, we're using, today's rates for people, for consumables. We've got really from the ground up, the operating cost in the open pit has been done from the ground up. The mill operating cost has been done from the ground up as well, and so we feel pretty comfortable on the operating side. The capital side has been more of a benchmark study, factored study. And when you look at some of the factors, I'll give you a couple of data points. We've got the indirects sitting at about 35%, and contingency sitting at about 25%. And when you look at, I'm going to say the last maybe 10 PEAs that have been put out, those percentages are like in the 90th percentile of conservatism. So again, we didn't, like I said, stretch the elastic too much on that. We didn't stretch it at all. In fact, the group we worked with, just wanted to make sure that the numbers they put forward were doable.
Right. And how much of the initial capex was for infrastructure? Because you've talked to me in the past about, I can pick up my Starbucks on my way to the office and it's still warm by the time I get there. So you're obviously where you want to be, near the town of Gander, but are you having to pick up anything later for the kind of upscaled version, the phase 2, or is that all factored in?
So in phase 1, there's a few things we have to do. I mean, we've got to build some shops on site. We've got to bring some mine equipment in. The mine equipment's the biggest chunk, but we've also got some and fuel bay and those sort of items. We've also got to reroute power line. There's a power line goes right over top of our operation, over the open pits, the planned open pits, and then we have to connect to the main highway. So there's and have power, and so there's a number of on-site and off-site infrastructure that's required. And as I mentioned, we've allowed for about $40 million of upgrades to the custom mill that we're looking at. So again, being, I keep saying the word conservative, but I'll say fair in terms of putting out a number and then factoring additional items. In the expansion of the 7,000 ton a day plant, we've allowed for things like a 200-person camp to house the people that would be brought in from the outside to build that plant, the specialized people. Usually there's about 300 people that you add over and above the long-term jobs that you create when you're building a mill like that. And so we've allowed for basically 2/3 of those additional skills to be from the outside. When you look at where we are, an hour drive away from the project site, it's a community, a larger number of communities that total about 40,000 population. So we think that given that size of population, knowing that many workers that have the skills we would be looking for fly in and out to the various operations in Canada, the mining operations out in Fort McMurray, up in Nunavut, Detour Lake, those sort of operations, we know that, we believe strongly that we'll be able to recruit them locally.
Okay, understandable. We haven't talked much about Met work. With that, obviously, given the nature of what you're seeing here, I appreciate you've got experience of these sorts of systems in the past, but the Met work done today and the, I guess, ongoing evaluation of how you process. And
Yep.
obviously, given the route that you're choosing as potentially as well, payables at the other end, because that's where the money spits out. Can you just talk through again some of the assumptions around what you expect to see in terms of those ebbs and flows?
Yeah. So the metallurgical work that's been done to date really has been in three phases. One and two grabbed samples from Keats, Iceberg, Golden Joint, and Lotto, and the focus was on grade bins. So different grades were tested to see what the recoveries were, and we saw that above 2 grams per ton, we got, well above 90%, so call it 92, which is what we've assumed here. But above 2 grams, we got 92 with just a simple crush grind, gravity, and leach. Once you got below 2, we did notice in the test work that the recoveries weren't as high, in particular in the leach. Still very good gravity, but in the leach wasn't as good, and that was just an indication that we had refractory material. So in phase 3, we did similar test work with the Keats West material that has more refractory arsenopyrite refractory material. And what we determined was that we would need a flotation circuit and generate a concentrate that would then get sold in order to recover that refractory material. So what we assumed that about 48% of the gold would end up in doré, and 44%, I believe it is, would end up in a concentrate. If you back up a little bit, you say to yourself, well, if 75% of the gold is in 25% of the tons, and that's above 2 grams, then again, the kind of recoveries we've assumed in our model would be conservative if we're saying that above 2 grams is a 92% recovery. So we've got more met work to do in order to really nail down this whole process, and so we're laying out a full met program that will be to feasibility standards, so that we can go straight to feasibility as the next step.
Okay, understood. That'd be nice to see, actually, that level of detail. So obviously, moving forward, the market's going to have a look at this. Your message to them is quite simply what? Wait for us to generate some cash to self-fund a growth story.
Right now we're doing the infill drilling. So we've published some results already, and we're quite encouraged that the infill drilling is confirming what the resource model is telling us, maybe a bit better. 2, we've got that definition drilling of the high-grade veins in order to better understand what's, how to estimate those high-grade intersections. We're doing excavations. So we did channel sampling of the excavation that was done at Iceberg, and those results will be coming out in the next months. We're excavating Lotto right now, which would be another one of the first pits that we would be mining, and we're planning to do channel sampling there right at surface. to demonstrate that the mineralization does come right to surface. So that's on the resource side. And as we just mentioned, the metallurgical work and the completion of our baseline work. So that's all project related. But let's not forget we've got basically 2 drills turning on targets that are afield that will, that are following up on some pretty great results up at Dropkick and Rab. And, our objective is, yes, there's that phase 2 that, shows that 172,000 ounces a year for 5 years. I want to start filling in that back end of that production profile to maintain that level of production going forward.
Okay, well, that's an important point you make, and something I wanted to come to almost finish with. And I will come to that. Can it's just on the underground component, if I may, in terms of what you've done in the past and what you're seeing here. Are you going to be able to kind of lay out a kind of plan for how you kind of deal with that kind of mining dilution and recovery from the underground? And so, remind me when you said you think you'd be able to kind of talk to that a bit more.
So, when we look at the underground, it's we're looking at developing it in year 5, and it'll go from years 6 to 10. It's a nice sweetener on top of the open pit. It was done, most of it's in the inferred category, more than half. And, of the 400,000 ounces that were in the resource, we converted into a mine plan about 230,000 ounces. And so, over that period of time, that's the sweetener. And for us, there's still a lot of work to do. We've got, we've assumed a mining method of cut and fill, which I think is a reasonable one. Having said that, we've assumed a 3-meter mining block as a mining width. When it comes to narrow vein, I've mined much narrower than that, down to 1.2 meters. So that extra planned dilution we can work on, and it's getting the right engineers involved, I think, to go about that. And so that's why we've said, that'll be our phase 3. That will come only in year 5. We've got much more work to do, much more drilling to do in order to, be confident. And the one thing I'll say is, look, it's divided up into 5 ramp systems over a 4.5 kilometer length, or strike. 5 different ramp systems. These things are wide open. Like, they're wide open. And when you think about it, these 5 ramp systems, if you stick that in the Abitibi, it's basically 5 different mines that are running in the Abitibi. And so it's wide open at depth and on strike. And again, more drilling to better define what we've got and to expand them because they're wide open.
Okay, and let's jump back to the important point that you made at the end, which is obviously, I think it's easy for people to kind of look at what we're talking about today and say, well, is that it? No, is your answer. So this, we're talking currently 15-year life of mine, 1.5 million ounces, AISC number somewhere around 1,200, right? But there's more to come. So 2 drills still turning. Can you talk about the type of targeting that you're doing? Because not all ounces are born equally, and to kind of bring that into this the production that we're talking about today, what are you chasing and where?
Well, we're chasing the the intersections that were released up at Dropkick, which is 11 kilometers to the north of the AFZ core, or the mine plan area. A little bit to the south of that is Pistachio, and it has a number of different good targets, shaping up to be quite similar to the high-grade areas of what we've put in this mine plan. And so it's just a question of drilling them out. The one thing that has been commented on about Newfound are the number of meters that have been drilled. The unfortunate reality of a deposit like this, when you've got a number of veins that orient in different directions, is you just got to put the meters in to define those ounces. And on a ounces per meter basis, we need more meters than the average gold mine out there. However, our average grades are higher when we do hit. So there's a balance there, and that's really what it's about. So that's why we've got 2 drills turning on these targets to replace or add to the ounce profile that we have in our current 15-year mine plan.
Can I ask, and it kind of harks back to your previous experience of bodies like these, is what are you building to? Because I think some companies like to kind of build the number of ounces, and you've talked a game now with this, look, new team, new plan, new business plan, new strategy, and it's very much focused on let's produce cash, a lot of cash. The drilling is geared up towards bringing ounces that are going to be mineable in short order, rather than chasing something to build up to have the kind of, I guess, the profile, ounces profile of a major, it seems. Can you explain what you're trying to be, and what we should, as investors, be looking forward to, and more importantly, how we should value you going forward? Because I think the previous team had a very different view from what I think you do. So could you maybe just finish off by telling us what it is that we should value?
Yeah. So again, I mentioned earlier on, the NPV we've got $742 million at $2,500 was something that we sacrificed in order to have that higher internal rate of return, and which is well over 50% at the 2,500. It jumps over 100% when you get to the spot price today, and so the strategy, the objective was always, let's get into production, let's see how these high grade veins behave. Because great, we can drill it at tight centers, but the truth machine is really the mill, and it'll tell you how much gold you've got. And as I've said, in these kinds of system, I've always seen overcalls when it comes to the ounces. By getting into cash flow quickly, as soon as we can, minimizes the dilution to shareholders. Having a solid plan will minimize the capital of this small mine, and therefore will minimize the amount we have to raise for the project financing. Taking from where we are today, having a phased approach, one that, look, if we're a year late on our permitting, that doesn't matter. We can still produce at the small mine. We're not beholden once we're cash flowing, and so I think it really does de-risk this growth plan, this phased plan, when it comes to that. So it just makes sense to me to get to the cash flow, small mine, and use that cash flow to build the bigger one. And in fact, the cash flow generated in those first 4 years at spot today more than pays for the growth capital.
Keith, appreciate you spending some time with us today. Obviously a lot coming down the line. Stay in touch. Thank you.
Thanks, Matt.